Hello everyone, welcome back to my channel. Whenever someone uses financial jargon, it seems to me like it would be something complicated. However, when I come to know the meaning, it turns out to be quite simple. In this video, I'll be talking about two terms associated with the credit card industry, that is, transactors and revolvers. Also, if you go on to like this video, please click on the subscribe button. It motivates me to make more videos. Coming to our topic. For those of you who don't know, a credit card is a payment card that can be used to purchase various items. The credit card has a credit limit up to which you can spend in a month. The card issuing bank makes the payment on your behalf, and at the end of the month, you have to pay your dues by paying the credit card bill. If you fail to pay your credit card bill, then you will have to pay interest and late fees. Now, transactors are people who make their entire credit card bill payment every month. They pay it before the due date and hence they don't have to pay any interest or late fees. This makes them less profitable for a credit card company because a credit card company mainly earns from interest and late fees. In fact, a transactor gets free monthly credit without incurring any interest charges. All they have to do is stay disciplined in paying off their monthly dues. The only income that a credit card company gets from a transactor is the percentage fees paid by the merchant when a transaction is done. The credit card company can also cross-sell other financial products to a transactor in order to get additional income. Coming to revolvers. Revolvers are people who do not pay off their entire credit card dues at the end of the month. Credit card companies give their users two options. One is to pay off their entire outstanding amount at the end of the month, and the other option is to pay a minimum amount out of the total dues and carry forward, that is, revolve the remaining amount for payment in the next month. Let's say there is a credit card company that has a minimum payment requirement of 5% of the total dues. You have a credit card bill of rupees 100. Then you have the option of paying just rupees 5 and carrying forward the remaining 95 rupees to the next month. By paying rupees 5, you will not be considered a defaulter by the bank and you can continue using your credit card in the next month if you have any unused credit limit left. However, you will be charged 40% interest per annum on the carried forward amount. This interest rate is so high that you might get trapped in a debt trap. Every month, the revolver keeps paying the minimum amount and carrying forward the balance. The bank keeps adding interest to the outstanding amount and the revolver's debt keeps increasing. He was not able to repay his dues in the first month. Then how will he ever be able to repay it when such a high amount of interest keeps getting added to it? A revolver increases the net profit of the credit card company and makes them richer. On the other hand, a transactor gets interest-free credit and he is also able to take advantage of the various discounts and perks that a credit card company offers. Now, it is up to us whether we want to become a transactor and take advantage of this wonderful financial product or become a revolver and get trapped. If you have any doubts, then feel free to ask them in the comment section. I would be glad to answer. If you have any video suggestions or you want to discuss any topic with me, then you can connect with me on social media. I've put the links in the description box. If you like this video, please give it a thumbs up and subscribe to my channel for my upcoming videos. Do share it with your friends and family who might be interested in finance. Stay tuned. Thank you.